friend, your host and tutor. Basically today we are going to be talking about entry models. So how to identify those models and how to use them on the chart. So without further ado, let's just head straight to the video. Okay, so now let's say and what is an entry model actually? An entry model, I can term it as a pattern you use to enter the market at a particular time. You understand? So that is how you can try to get what a simple definition of entry models is. Just like a pattern or structure, or let me say a setup in which you can use to enter the market at a particular time. So now we have different type of entry models. People trading structure and liquidity, people trading SMC, people trading retail trade. So a lot of entry models, but the way I trade my own, or let me say the entry model I used to trade is basically structure and liquidity entry models. So we have these types. I trade these types of models. They are just basically three, or let me say four, but the fourth one is, let me say, optional, but it's also part of the A plus setups or A plus models that I can use. Now first we have this model, something like this, a I, another I, then we have this, right? We have this is the first model trade. You understand? So after this is the first break of structure. Can you see? Now this type of model comes in three forms, or in two forms. It can either be like this, this I breaking this I here is called a false pullback. You understand? This I here is called a false pullback. After calling this a false pullback, now one thing you should know about false pullback is that anything that is called false pullbacks, or any I that breaks this I without the mitigation of a demand zone at this point, is called what? It's called an inducement. Yeah, this side is called a what? It's called an inducement. You understand? So for this side now, you can call it X. Alright, so this is called an inducement. So because this is a fake pullback or a false break of structure around this side, now we can even call it this a what? An inducement, because this inducement or this low did not mitigate this area. So now henceforth, price now have to do what? Break this high. You understand? Now allowing or ensuring that price comes back to this low and clear this liquidity, and then moving to this other block around this demand zone here. You understand? For price to move to the upside. You understand? So this is the first entry model in terms of trading, or how I trade. You understand? So now this type of model can come in two forms. This is the first one, and this is the second one. The second one is like this. It's either in an inducement form or in an engineered liquidity form. Something like this. We have something like this. So this is the second part. Yes, this is the second part. We can have something like this, where price did what? Engineers it creates its own liquidity before getting to the PY entry around this area. Can you see? So instead of price breaking this high, so if price for this PY to be valid, if price is looking for any entry or any order to take from this zone, it must do what? Create an engineered liquidity. You understand? So in this sense, if price is not creating this zone, if price is not creating an inducement, rather it's going to create an engineered liquidity. Yes, that is just it. So this is another type of model in relative to what? This one. So we also have another two types. We have this one too. It is similar to this, but it is a different case entirely. Now this is it. Okay, coming. So this is it. We have a sweep of liquidity, and after that sweep of liquidity, we have this inducement. Now we then have this this order like this. Now this is what people call it, commonly term it as what? SBI. This is called a sweep of liquidity. This is a sweep here. This is the sweep. Now this is the inducement. So the B is for break. These are the breaks. The breaks are like this. These are the breaks here. This I. We also have another one here. This I. You understand? So these are the these are the breaks. Now the B is what? Breaks of structure. The S is the sweep of liquidity, and the I is the inducement. So looking at this one now, you can see it is similar to this one, but it is different. The reason why it is different is because of the sweep of liquidity that is present at the zone. Now this instance, this sweep of liquidity can be traded in terms of there are some cases where you can trade this in terms of when price mitigates a POI, right? A higher time frame POI, you understand? So you can use, once you see this sweep of liquidity, breakout structure and inducement, you can trade it, assuming it's in a downtrend. Now you can trade it in the form of what? An uptrend, just for a short period of time. If price mitigates an higher time frame or a higher time frame POI rather, you understand? So you can just trade it in line with the mitigation of the what? Higher time frame POI. But in this sense, this type of POI is mostly effective in continuations. This one is mostly effective in continuations. Now, for any reason we are seeing this type of sweep, you can try to trade it in terms of reversals. You get, but in most cases, it is very rare for you to trade a reversal using this model. No, it is very rare. Now you can only trade this one in a best possible way. Trade in terms of what? Continuations of a particular trend. So now, this one also comes in two terms. It also comes in an engineered form where we have a sweep. But this time around, it does not come with a break. You have a what? We have something like this. We have a sweep. Now, after the sweep, we have something like this. We now have what? An engineered liquidity like this. Something like this too can happen. So, an engineered liquidity instead of a break there. So, it's called what? An engineered liquidity. So, price will just have to do what? Come to this demand zone or other block on the other side and mitigate. So it comes in the two forms like that, either an inducement form or an engineered liquidity form. Those two ways, you understand? So these are, how many models are this now? We have, let's say two. We have two, but the two is like 2 in 1. You understand? So we have like 4 like that. So we have this first one, an inducement or an engineered liquidity. The second one, an inducement or an engineered liquidity. So now, as well as this, we also have another one here where we have a breaker. We have breaker like this. This is a breaker block. This I. Okay. After this, we now have this run of liquidity. After this run of liquidity like this, price tends to do what? Come to this low and move to the upside. Can you see? So let me move it up. Alright, so now moving like this, can you see that this is a breaker block, right? After this massive run of liquidity here, this massive run of liquidity here, can you see? So you can call that what? A breaker block. Understand? You can call it a breaker block. So price tends to use this one. So for every run of liquidity that happens, there is a possibility that price will not come back to this demand area here to do what? To mitigate. There's many possibilities that price will not come back to this demand area and mitigate. Instead, it will use this failed OB or other block, whatever you want to call it, to use this fake other block to do what? To enter, so it will mitigate and move to the upside. You understand? So this is how it works actually. You get the point. So something like this, a breaker block. You get this is a breaker block. So we also have something like a mitigation block. So they are called expansion type entries. You understand? They are called expansion type entries. So this one can also come in terms of an inducement, where we have an inducement first, price moving like this, looking for a small inducement like this, then you cannot see this price move to the downside like this and continue. Can you see? So it can happen like this and it can happen at the first one. So this is how it actually works. This is a breaker block. You understand? So now this is another one for the mitigation block. Now, one thing about breaker blocks and mitigation blocks is that they are called expansion type entries. Yes, they are called expansion type entries, and they are valuable when you have liquidity runs in the market after a failed order block. You understand? After a failed order block. So that is when it is valid. You understand? It is either coming in form of a liquidity run, comes in form of an imbalance or a FEG or fair value gap. So that is how it works. You understand? So this is a form of mitigation block. The mitigation block comes this way. Now something like this. Yeah, something like this. Yeah, so this is a what? A mitigation block. Why is this called a mitigation block? Now we can see this is a what? This is a failed swing, a failure swing, or a failed swing. You understand? So after that failed swing, price did what? Price created a massive pull to the upside. After that massive pull to the upside, that we called a liquidity run, or an imbalance, or what? An FEG. You cannot see that price did what? Price came back to this zone with an induced, price created an inducement first, coming back to this zone, and then do what? Taps and move to the upside. Now the difference between this is that these higher highs and lows are broken, right? But here there is a what? Failure swing. That is the difference between the mitigation breakout block and mitigation block. That's the difference, but they are both expansion type entries. And mind you, breakout and mitigation block can also come in form of what? An engineered liquidity, where we have something like this, like the first one I explained to you. So like it can come like this too. It happens like this too. This price will drop. This something like this happens to both on mitigation and breaker. So in any way you are looking for this, please either price creates an inducement for us, or price engineered liquidity by itself close to the PY. Those are the two things you should note. You can understand? Those are the two things you should do. What you should note. So now let me go to the charts and then look for models that's really similar to this. So now all right, so this is the first one. Okay, yeah, so now this is the first one. Kindly look at this. This is a break of the low, right? This is a break of the low, right? So after this break of the low, we have this. In terms of this structure, if you using a line chart, you can see what I'm talking about. Actually, using a line chart, actually, can you see that this is what this is? At first, this is an engineer liquidity. This is what price is trying to tell us. Yeah, price is telling us that it is doing something like this. It's doing something like this. Can you see? Price is doing something like this. This is what price is doing actually. Can you see? So this is what price did actually. So using a line chart, you can even see that it is much more clearer on the line chart than on the candles using candlestick. Understand? So now looking at this now, you can see that this is a what? This is a zone for this is a failed order block around this area has been mitigated, right? Is observed, and this is a run of liquidity. Look at this massive candle that happened here. This is a run of liquidity. After this run of liquidity happened, we now have what? An engineered liquidity beneath. Can you see here? This is an engineered liquidity, right? This is an engineered liquidity. So after engineered liquidity, you can see that price did what? Price moved to the upside, making it to what? Available for the position. And one thing you should know about this type of trend is that this type of models is that you should always trade them in line with the trend of the higher time frame. Yes, you should always trade them in line with the trend of the higher time frame. It is much more important. You understand? It is very, very important. Don't trade against it, because most cases it doesn't work if you are trading against the trend. You understand? It doesn't work if you are trading against the trend. So you must trade in line with the trend at all times. You understand? So this is another example of a mitigation a breakout block. Is another example. Can you see? Is another example. Price did what? Price used this zone as inducement. It is used as inducement because we have a high here that has been broken. This is the first break of structure that happened here. So this was an inducement. So price did what? Mitigated and push again. Is another example. So I've completed the first example for the breakout block with an engineered liquidity, and a breakout block with the what? If an inducement. So now moving on, I'm looking for another setup. Okay, right here we have another one. Now moving on to the 3-hour time frame, or let's say 4-hour. Okay, let me go to the 2-hour time frame. Okay, all right. So now it is clear. So moving on to the 2-hour time frame, you can see we have, what do we have here? We have this sweep of liquidity. Can you see? We have this liquidity sweep here. After liquidity sweep, we have what? An inducement here, right? Now, one thing you should know that you can see that I'm trading in line with the trend. Can you see, guys? I am trading in line with the trend. I'm not trading against the trend at all. This is always in line with the trend. Can you see? It's in line with the trend. We have this lower low, lower high, lower low, lower high, lower low, lower high. Then you have this mitigation from this side. You have this lower low, then you have another lower high. After this lower high here, this is lower high. Can you see? So we have this inducement. Then this sweep of liquidity, SBI, sweep of liquidity, inducement, and order block from this zone. So we have this order block from this zone. Can you see, guys? So price did what? Price tapped that order block and dropped massively to the downside. Can you see? So it is much more easier to identify all these type of trades. It is much more easier. Can you see, guys? So you can see a massive sell that happened here. Now, likewise for this one that I tapped, you will notice that we have the reason for the sell that happened here. Now, firstly, it's on a downtrend, right? That's the first one you should look at. It's in a downtrend, right? Now, the second one is that we have something like this. Something like this happened. Something like this happened after this downtrend happened. Now, this is what happened actually. This is the scenario. We have something like this, price dropped, create something like this. So okay, so price dropped like this, a high, dropped again, right? Created something like this. Can you see? So price dropped like this, moved to this high, around this high, then dropped. Okay, created a equity here, dropped. Can you see? So price did what? Move to the side and drop. So this is what happened here. Yeah, around this side. Now this is what happened. Can you see that there is another block here, right? Another block is found prominent here. Another block was found prominent here. Can you see, guys? Another block was found prominent. Now you can see this is an inducement. Yeah. Now the reason why this low this other block was valid was because one, this low here was broken. This was like a shift in market structure that happened. Still on the downtrend, right? That was like a shift that happened in the market structure. Yes, confirming that this inducement is valid. Now the inducement occurred here, the other block was present here, and price was mitigated around the zone and dropped. It's as simple as that. And dropped like that, and even still in the line with the trend, Can you see? So it happens every day, almost every day, on any type of pair you want to trade. So I'm kind of looking for something else. So okay, all right. So now that is what it actually entails. So there are different types of things. So if you're looking for any model that you want to trade now, and you're looking for okay, now I've seen one again in line with the trend as well. We have this breakout block. Can you see? This is a breakout block. Sorry. Now this is a breakout block, and this one. Can you see? The breakout block here. Price broke structure like this. 1, 2. Yes, price broke structure. Use this one as what? An inducement. Now, and I told you a breakout block comes with a what? It comes with a massive run on liquidity. Look at this imbalance here. This is an imbalance here. So this inducement and price did what? Price dropped. Price did what? Price dropped down. You can see. So after price dropped a little bit, you can also see that price did what? Created an inducement and another block here, making for price to do what? Tap again and drop. So it is many on the chart. There are many things on the chart that you can see. Many things on the chart that you can see. So there are a lot of this. So I want you guys to go to the chart now and study as much as possible as you can, and try to figure out how you can trade these patterns or how you can trade this model on your chart using the lower time frames and the higher time frame or multi-time frame analysis. And everything you must be trading, or everything you must be doing with this type of pattern should be in line with the trend at all times. So without further ado, I would like to remind you that you should subscribe to my YouTube channel, and hit like and notification button in case any video content drops again. So I'll see you guys in the next video.